in this course, I will provide an in-depth overview of foreign exchange trading, or Forex trading for short, where the underlying asset class traded are currencies. I will cover the basics, such as simply what is Forex trading and common Forex terminology, and I will also cover more intermediate to advanced topics such as fundamental analysis and risk management practices. I will also run through a few historical and live trade examples. So just a few quick things I wanted to note before getting started. And first, you will get much more out of this course if you pause after each lesson as well as intro lesson and apply what you learn rather than quickly speeding through all the topics. Second, I want you to know that these course videos are not the only thing you will receive from me, and if any of the concepts I cover are unclear or you want to go one step further, please do not hesitate to reach out on this course's discussion board, and I will be sure to answer any questions you may have. So, continuing on with this introduction, I wanted to provide a quick high-level introduction to some of the Forex market concepts. So let's go ahead and begin that. And so similarly to the stock market, where stocks are traded, the foreign exchange market is a market where currencies are traded. Unlike the stock market, which consists of several thousand different stocks, the Forex market has a much smaller universe. Furthermore, of this universe, it becomes even smaller because most Forex traders focus on a handful of major currency pairs, including the euro dollar, the dollar yen, sterling dollar, dollar Swiss franc, dollar Canadian dollar, Australian dollar, US dollar, New Zealand dollar, US dollar. And don't worry if this seems like a bunch of jargon, we will cover in this course, each of these currency names. And so, unlike the stock market where you have to screen for thousands of stocks to find the best opportunities, Forex traders have a much smaller universe and therefore have a much more narrow and more focused research. So, as it relates to retail traders like you and I, Forex trading is the speculation on the price of one currency against another. So here's a high-level example. And so let's say you exchange 90 units of currency ABC for currency XYZ. And the current exchange rate is going to be 0.9. But then let's say overnight, the XYZ currency against the ABC currency appreciates from 0.9 to 1.0, meaning that currency XYZ has increased in value relative to currency ABC, and therefore when you exchange the 100 units of XYZ back into currency ABC, you would receive 100 units, which is 10 above your starting value of 90 units. So in this instance, you would have had a positive profit and loss. So applying that to the Forex markets, let's look at a chart of the US dollar Japanese yen currency pair. And similarly to the stock market, you want to buy a Forex pair low and sell it at a higher price than what you bought it, and the distance from which you bought the pair and sold the pair will be your profit. Vice versa, similarly to short selling in the stock market, you can also short sell or sell currency pairs, and so you want to sell a Forex pair at a higher price than what you buy it back. You want to buy it back at a lower price, and that difference will be your profit. This course will also cover some of the fundamental factors that determine a currency's price, and some of these include GDP, trade balance, inflation, interest rates, central bank decisions, and many, many others, which will be discussed in greater detail later on in this course. And technical analysis is another form of analysis used by many traders and includes the use of moving averages, Bollinger Bands, stochastics, Fibonacci, support and resistance, etc. You might be wondering why the Forex market exists. One of the reasons is because currencies need to be exchanged in order to conduct foreign trade. For example, a US-based electronics producer may need to purchase semiconductors from a Japan-based company, and to do so, the US importer would need to exchange US dollars for Japanese yen. Similarly, if a US citizen goes on vacation to Europe, he or she will need to convert US dollars to euro to pay for goods or services. It is worth noting that unlike the stock market, which is housed in central physical exchanges, the Forex market and foreign exchange trading is completely electronic and is conducted over the counter, where transactions are done via computer networks between traders. And the Forex market is the largest, most liquid financial market in the world, and according to the Bank for International Settlements, Forex trading averages 5.3 trillion in daily transaction value. Forex market participants are comprised of institutions, corporations, governments, banks, hedge funds, and speculators, and about 80 to 90% of total trading volume is driven by currency speculators looking to capitalize on intraday price movements. So with that serving as a brief overview, let's go ahead and get started.